Good morning, welcome to Ainslie News, Monday 27th of July 2020. Hope you've all had a reasonably relaxing weekend. Today we're talking supply-demand collision, record deliveries for the COMEX and ETFs. Last month, COMEX, the largest gold futures exchange in the world, saw an all-time record of 5.5 million ounces or 170 tonne of gold physically delivered, when the norm is around just 100 to 500 ounces. Silver deposited into depositories, ETFs and funds saw another new all-time weekly record. Demand is exploding at a time that COVID-19 is restricting supply. Since the 23rd of March, amid the global panic around the onset of COVID-19, there have been extraordinary pressures on the world's two biggest gold markets, the London bullion market and the COMEX in the UX. We explained this previously, and that spread of price between the spot price and London and that on New York means players have been buying gold in London, taking a long contract on COMEX and shipping it to New York for delivery to take that profit. It's arbitrage at its simplest. That has, of course, put pressure on premiums for physical metal, as we've seen around the world. This next chart that we're going to show here shows the unprecedented volumes of deliveries seen. Just focus there on the far right part of that chart. 5,500 ounces of gold. Huge step up from that around 1,000 to 1,500 as per normal. The legendary Egon von Greyerz just wrote this of his 4 key drivers of higher gold prices. The gold price will be fueled by 4 incredibly strong factors. The major debasement of currencies due to money printing, substantial shortages of gold in LBMA and futures markets, major new private institutional gold investors entering the market, only smaller quantities of gold available at current prices. Topically, on that previous discussion on the dynamic between LBMA and COMEX, in his second dot point, he expands. But there are more factors that affect the gold price. There is a massive shortage of physical gold in the futures markets and LBMA system. As gold goes up and the holders of gold ask for physical delivery, there will be no gold available to settle the paper claims. There are only 2 potential outcomes. A default of the LBMA system, which would also mean a total bank collapse. They will attempt to settle the claims in paper money, but that will also lead to defaults eventually. It is of course possible that central banks print trillions of dollars to save the banks so that they can buy the gold. The problem is that there is no gold available at current prices, but only at multiples of the current price. And the more money central banks print, the less it will be worth and the more that the gold will cost. So a real Sisyphean task that is guaranteed to fail. In addition to COMEX, we have just witnessed another huge week of gold into ETFs and mutual funds, as well at 2.49 million ounces, and not surprisingly the biggest weekly deposits on record for silver, a massive 44.28 million ounces of silver in just 1 week. Check out this next graph here, weekly transparent gold holdings. Lovely rise there, and straight after that we'll show you the weekly transparent silver holdings as well. Huge kick upwards there at the end. Or which is exactly now. The guys at Visual Capitalist just released the following infographic, explaining how all this comes about and the broader pressures on the gold market due to COVID-19. It is worth clicking on the image. If you can, zoom back over to ainslieBullion.com.au and check out today's news and check out a better quality image, but also the expanded explanations in the text below it. This is a pretty big graph. It's going to be impossible to view this in YouTube or on Facebook, so please go over to the website and you'll be able to check out this full infographic. And that pretty much summarizes news today. We'll see what gold and silver brings to the volatile markets this week. And always jump over to our website, ainslieBullion.com.au, for all things gold and silver, and ainsliewealth.com.au for all things cryptocurrency. We'll catch you tomorrow.